Hello and welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. Today we have a few topics for you. First is the market update. It's actually not going to be too long. We just want to talk about things that have been driving the markets as well as the things that have been happening this week. Some exciting things is that there's never a dull day. It makes my job exciting. I also want to talk about a few topics that are on everybody's mind, it seems, and that topic is affordability and everything that comes with it, including some of the chatter from the White House regarding efforts, it looks like, to lower the mortgage rates for everybody and whether or not that would be effective. And there's also been a lot of chatter around the Federal Reserve and its independence. What does this mean? Whether or not it'll be effective, all of those things. Okay, so before we begin, everything you hear is for informational purposes only, educational purposes only. Nothing you hear is investment advice or recommendation, and it's all my opinion. All right, let's go to market update. I'm going to pull up my numbers. So the first full week of the year was last week. The S&P 500 index returned 1.6%, including the Friday before. It would be month to date 1.8%. That's month to date, quarter to date, year to date, etc., because we're still in January. Between growth and value, we sometimes talk about those styles. Growth, Russell 1000 growth is representative of stocks that are considered to be growing, so they return less dividends and less back to the investors, and whatever they earn, that's earnings that are not being spent, it's actually invested back into the company. And they tend to be certain sectors like tech, for example, companies that are continuing to innovate. Value companies tend to be a little more old economy sectors like industrials and banks, etc. These things are getting fused because early this week, which would be yesterday, we learned that Walmart just joined the NASDAQ. So Walmart's interesting because it is clearly a retailer, and we actually watch them very, very closely for the health of the U.S. consumers and how everything is looking. And Walmart has done a really good job of getting caught up in the online retail platform. Remember those days when that was the thing that was, the most tech thing you could do? They've been very, very successful. Last fall, I don't know if you remember, but they partnered with OpenAI so that if you ask questions about products and merchandise on OpenAI, it may suggest to you a few things, but you can actually go in and purchase from Walmart through OpenAI. So there are these relationships that Walmart has been making and establishing. And it's clear that even though it's retail, it's slowly becoming a tech company. Okay, so in some ways it's symbolic that Walmart has joined NASDAQ. So going back to styles of value versus growth, because they're a discretionary old retailer, you might think of them as kind of an older retailer because they've been around for a long, long time. They might be growing really fast, right? I mean, I don't know what this direction is, but to me, that's growth and value. Okay. Russell 2000 small caps did really well at 4.6% for the week. Month to date, that's including January 2nd, they're up 5.8%. So we're really starting out the year with our foot on the gas pedal. This is risk on. For some reason, everyone is really optimistic and happy about 2026. I'm glad, but to be honest with you, for someone in my profession, every turn of the year, it's a little bit, I wonder what's going to happen, especially when you've had a positive year like we had in 2025 in the S&P 500 index. Same thing in 2024. We had a positive year. We had a positive year in 2023. The last time we had a negative year was in 2022. So when you have 3 consecutive years of positive returns, valuations we know are high. It's somewhere around 22 times 22x on the PE multiple. That's high compared to history. You start getting nervous. Maybe there will be a calendar year effect where everyone feels a little bit differently because it's not 2025 anymore, and maybe some of that excitement fizzes away. That is not how we started the year. It continued into Monday, and now on Tuesday, which is when I'm recording this, we actually had some paring back of some of those gains. All right, that's on the market update. Let's me go back to my notes. Okay, let's talk about affordability. This is a big topic. And as I mentioned earlier, this is a topic because it's always been a topic, but it's front and center, and especially in Washington because it's an election year. It's just kind of inevitable. And let's just face it, everything is expensive. Nothing has really gotten cheaper in a meaningful way. And part of it is not because inflation itself is high. As a reminder, inflation is the rate of change of prices. It is not like the fact that it's going up. It is going to go up. The question is how quickly. So inflation in the last 2 or 3 years, it's been about 2.5% to 3%. That's where it's been. Actually, we got the CPI number today, and the headline CPI came in at 2.7%. Core CPI, that's removing food and energy, core CPI came in at 2.6%. So this isn't like runaway inflation. Remember when inflation was like 9% a few years ago? That would be really high inflation. So inflation itself has come down and it's been pretty stable, but that doesn't mean the prices are going down, right? Prices are going to keep going up just slowly. That's what it means. Have the wages kept up with it? For some people, yes. For a lot of people, no. And the biggest thing here is on the housing, right? So if you wanted to buy a house, if you wanted to borrow money, to finance to do anything, that would include for most Americans buying a home and buying a car. These are the two large big ticket items that we need financing for. And it's relatively readily available, but depending on your credit score and what the prevailing interest rate is underneath everything, which the treasury rates, it could be super duper high, and it has been. So this is eating into the purchasing power of most Americans, and so affordability has become a big issue. Housing is big because let's talk about housing for a second. A house is very personal. I have my house here. This is where I'm making all my memories. Lucas and Stella, my dogs, whenever I picture my house, I picture them in it, right? So it is very, very close to my heart. So it's just not just an asset. It's not something I just own and build equity in. That's important too, but it is very personal, and it's not just an asset. Let's put it that way. I don't want to get too personal about it, but you know what I mean, right? That this is where we raise our kids and all of those things. It has been, and I've covered this in other videos, very difficult for new entrants into the housing market to buy a home unless they have help or unless they find a really bad fixer-upper. Even then, those are also expensive. And part of it is because there isn't that much supply out there. So it really is a seller's market still in a way. It has been. That's slowly changing. And so prices are high. In a seller's market, prices are high. And supply is low, demand is high. And there's that imbalance. So, prices are high. And then, of course, interest rates went up and interest rates are high. It's a double whammy for affordability of homes. And this has been a very, very big sticking point. A few weeks ago, was it months ago? I feel like it's been years, but it's only been like a month or two ago when President Trump talked about a 50-year mortgage. I have a video about that too, where I actually told you what I really think of those 50-year mortgages. I do think it's a bad idea. As I mentioned earlier, you build equity in your home. For most Americans, this is where we build our wealth. It's our biggest asset that we own for most Americans, a single asset. Don't think your 401k, et cetera. Those are tax deferred and those are qualified. This is your investment, right? And so if it takes you 50 years to pay it off, then you're that much slower in building equity, building wealth in your home, while your monthly payment might be slightly lower. And guess who's making more money? The banks are making more money. I just don't think it's a great idea. The next idea we have that's been floated around in the last week or two has been the Trump administration wants Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage-backed securities. Let me break that down for you. So mortgage-backed securities, what are they? Believe it or not, if you have a 401k or an IRA and you have like a bond fund in there, You have these things. You own these things. Just you may not think about it or know about it. These are the things that you can buy. They are securities like stocks and bonds. Now, why are they called mortgage backed? Let's say you buy a home and you get a mortgage. You work with a bank to get a mortgage, to get a loan for your home, and you're living in it and you're paying your monthly payment. Who are you really paying it to? Sometimes if you use a more local bank, I have a local bank that I work with for my mortgage. What they do is they lend you the money and that lending is in their portfolios. Okay, so when you pay your mortgage, the interest pay, the principal goes to pay back, the build equity in your home, but the actual interest payment goes to the bank and that is their portfolio where they're earning the interest. Okay, so it actually stays local. But a lot of times, especially with larger banks, what they'll do is they will lend you money and then they sell it into the marketplace. They don't actually hold it in their books. They actually sell it to people who want to buy those bonds. Okay, so because you're paying interest on it, I mean, interest falls, right? I mean, if we understand how mortgages work, in the beginning, most of your payment is interest, less is on the equity. The longer you hold your mortgage, your payment stays the same, but the amount that you pay for interest starts to go down. These are, it's income for somebody who was holding these things. So the big banks will sell them. They don't have it in their books. And so the people who buy them are bond fund managers, and that's where I'll kind of keep the story here. There are other people who buy them too, but the bond fund managers will buy these mortgage-backed securities. They have a rating on them and everything. They'll do their research and then they'll collect the interest that's coming in. So that's basically how it works. And so these are called mortgage-backed securities. So that's a really quick primer on mortgage-backed securities. Now, they are directly linked to mortgages because they are backed by mortgages, right? So the idea is that if you buy a lot of mortgage-backed securities, that because of that high demand, it would push down the mortgage rate. That is what they want to do, right? Push down the mortgage rate and therefore make it more affordable for people to borrow money, take out a mortgage and buy a home. That's the logic, okay? So again, if you buy lots of bonds, it pushes down the interest rate. If you buy a lot of mortgage-backed securities, the mortgage rates go down. Theoretically, that is what happens. And that theoretical is a very important word here. That's the caveat because guess what? The mortgage market is around $12 trillion. So you have $12 trillion worth of mortgages or mortgage-backed securities actually having an impact on the mortgage rates, right? So what's 200 billion out of 12 trillion? It's maybe a little more than a drop in the bucket, but not that big, much bigger. Okay, so the idea that $200 billion is going to actually have such an impact that it's going to move the price or move interest rates is not really, it's not really practical. Now, when it was announced, mortgage rates did go down. You might have seen in the headlines that mortgage rates dipped slightly below 6% for the first time in a really long time after this announcement. All that is traders reacting to the news, okay, and buying into the mortgage-backed securities. That's what's happening. That's very, very Wall Street and trading oriented. It doesn't mean it's going to continue to go down to like 5% unless something happens. So that is, so far the ideas are not great. Now, 50-year mortgages is one thing. I'm not really big into market manipulation because that's what this sort of is. Have you heard of quantitative easing from the Federal Reserve? This is a tool that they use to sort of manage interest rates across the curve. And the Fed for a long time bought two types of securities, treasury bonds and mortgage-backed securities. During quantitative easing, or you might have heard people say QE, okay? People hated this because they felt like it was market manipulation, right? And theoretically, it is market manipulation. You're trying to manipulate the price of bonds and manipulate the interest rate. So, and not letting it float based on market activities, right? And even at the Federal Reserve level, there remains big question mark whether or not the QE and all of those bond buying activities actually move the interest rates at all, because the treasury market is such a deep market, and there's a futures component to it, etc. It's a very big question mark, but it made people feel better because it was an easing policy. Okay, so far, not that great in my opinion. I'm going to take a little break here and come back in the next video to talk about the rest of this. The next thing I want to talk about is the credit card interest cap, which actually has been around in discussion for the last week or so. Is this a good idea? Has this been done before, etc.? So stay tuned. Credit card interest rate cap. So there's this idea that the government may be able to, or at a federal level, or should put a cap on how much credit card companies can charge you on the balances that you have. Now, I'll just come out and tell you that I don't think this is a bad idea. Some states already have this type of stuff. If not on credit card balances, then other type of lending activities. There are caps on various things, and that is really to make sure that the interest rates don't get out of hand. What banks will do is they will lend you money, in some cases credit card, if you keep a balance in there that is a form of lending money. They feel like they have to get paid for the risk they're taking, because if you start keeping a balance in there, the banks start wondering, can you pay it off, right? And so from their point of view, you become a more risky consumer, right? So the rates go up. But I mean, is the sky the limit? I mean, it's if credit card interest rates are like 30-40%, I mean, is that even feasible for someone to be able to pay everything off? Because let's face it, if a person, I mean, I think everyone would like to be able to pay it off because debt is a burden on your shoulders, right? If a person feels the need to keep a balance on the credit card, and we know that a lot of Americans do, because every month we get a report on the credit card balances, and a long time ago we went way over $1 trillion, okay? So a lot of Americans are keeping these balances on their credit cards. And when you feel the need to do that, that probably means that you're under some financial strain. And just when you are in the financial strain, sometimes these interest rates go up to levels that are really difficult to get out from under. Okay. So, from a personal finance standpoint, I don't think this is a bad idea. Let's put it that way. And frankly, I like the idea of consumer protectionism. I like the idea of the government actually protecting the consumers from a legal side better than manipulating interest rates. Okay. So capping it at 10%, wherever it might be, I think it also sends a signal to America, to our society, that, if you leave it to the market's devices, sometimes it gets to territories that are untenable. And that may be where we are with these credit card interest rates. So I think that's a good message to have some of this. Now, on the day that this came out, bank stocks fell. That tells you a little bit about what the relationship is between interest rates and bank profitability. Take that with, however you will. But certainly that was an observation. So this is my personal take on this, is that I don't think it's a bad idea. Especially when prices are high, affordability is an issue. This isn't actually addressing the prices of things directly. It is addressing the ability to pay for those things. If food is more expensive, and on top of that, your dollars are going to pay these interests, then, what are you left with, right? So this is really addressing the purchasing power, the disposable income side of your finances. Okay. Now, all of these things we talked about in terms of trying to lower mortgage rates so that people can actually borrow money to buy homes at lower mortgage rates, et cetera. All of these things, again, going back to the topic of affordability, it is really under one umbrella. It's really, we're worried about Americans' wallets. Okay. So, what's happening here is you see a lot of pressure on the Federal Reserve. And this isn't anything new. We've seen it throughout 2025. What did we see around throughout 2025? Chairman Jerome Powell has been called all sorts of names. There's been a probe into the renovation of the Federal Reserve building, which apparently went way above budget. Okay, now I've done renovations in my house and they've also gone above budget. So, but I'm sure with a historic building like that, you just never know when you knock down a wall what you're going to find. Like that's the nervous part of it. When you're a homeowner and you're trying to renovate your house, what am I going to find behind the walls, right? But also like anytime I set a budget, that's kind of understood that that's the floor. It's probably going to go over. Anyway, this has come to light. The latest is that the Department of Justice is taking a look at this, but not from an audit perspective, but actually looking into Mr. Powell himself. So this has gone from a Federal Reserve scrutiny to a very individual, personal type of a thing. And I will just come out and say that this is not healthy. Now, there are various opinions out there about Fed independence. I get that. There are people who don't believe that the Fed is independent. There are people who believe that the Fed is independent. You know, you're allowed to have your own opinions, right? What I'm saying is the independence of the Fed is important for the markets as a whole, not your personal opinion, right? As a whole. Because think about what the Fed does. The Federal Reserve sets interest rate policy, among other things. That's really powerful, right? So if there's this inkling that one individual or one branch of the government can actually sway the Fed to do anything their way, then it loses the perception of independence and then it becomes a political tool in the eyes of the market. And that is actually not healthy for the investing community. The Congress actually made the Fed independent for that reason. Okay, it is very, very important. It's not productive. And frankly, every president wants lower interest rates. This is not anything new. So this isn't anything special about this White House or every president would want lower interest rate because that actually spurs economic activity, etc. I understand. I've been talking about interest rates falling toward normalization, not to stimulate the economy per se, but just not to be so restrictive for reasons other than, you know, what the prevailing thought out there. But anyway, it's not good. So what should the Fed be paying attention to? Two things, labor market and price stability, which is inflation. And we got both of those reports in the last few days. We had the job market data from the Bureau of Labor Statistics on Friday, and that wasn't that great. I know the unemployment rate fell from 4.6% to 4.4%, and that looks like we're moving in the right direction. But in all honesty, if we look at the longer trend, we are actually trending up. Unemployment rate is trending up. 1 month to another month movement, that's noise. And then, of course, in terms of jobs gained, net jobs gained, we had 50,000 jobs gained in terms of non-farm payroll. We really want to see those numbers in the six figures. I want to see those figures like above 150,000, 200, 300,000 net jobs gained. That actually makes me very happy. It tells me that Americans are finding new jobs, new opportunities, sometimes for a promotion at a different company, sometimes for a higher pay. You can move up in the world. That's what that tells me. At 50,000 jobs gained, that's not what that's telling me, right? So in my opinion, it was not a terrible report, but it was certainly not anything to write home about in terms of its positivity. The other thing is the inflation print came out today, and it was kind of boring. It didn't change. Year over year, headline CPI number remained the same at 2.7%. core CPI number remains same at 2.6%. These numbers are, again, not anything to write home about. I don't know if you remember a few years ago, inflation was 9% year over year. So compared to that, we're not in a crazy inflationary environment. So from the Fed's perspective, these are benign numbers, but the labor market data is still coming in weaker than where it should be for a thriving economy. Definitely for rates to remain restrictive. Okay. So I don't think the Fed is going to cut rates based on the data and based on where we've been. They've been cutting rates all through second half of last year. So I don't think they're necessarily going to do that in January. I think it would be a surprise if they did. But I still think that they need to continue on toward the normalization of rates. Not to reduce mortgage rates, but because in terms of policy, based on the data they're supposed to be looking at, I think that is the right course of action. Now, I'm going to leave you with this one final thing. Even if the Fed were to be, and this is hypothetical, were to be swayed by the White House and cut rates, we know that that may not impact your mortgage rates. All through last year, as the Fed was cutting rates, the 10-year yield benchmark, which is the actual benchmark that your mortgage rates are based on, didn't move. It didn't go down. So my question is, why all this pressure on the Fed if your goal is to make housing more affordable? Because mortgage rates may not move down. That $200 billion of mortgage-backed securities that apparently they're going to buy or they were instructed to buy, that's not going to move the needle either. The thing that's going to fix the housing market is good old supply and demand. This is basic economics. We need more supply online to meet the demand. That's the thing that will actually fix the housing prices. All right, that's it for today. Tune in next week and have a wonderful week.